Thank you everyone for coming, settling in. I think this is the only conference that I've ever been to where everyone just gets quiet without, no dings, no bell, none of that. So really appreciate that. And I hope you guys enjoyed last night. I sure did. And if you missed last night, sorry we missed you, but don't worry, tonight and the whole day today is going to be even better. I'm just going to wait here to get fully situated. But yeah, we're pretty much ready to get started. So again, super grateful for you all to be here. Welcome to the LSC Summit 2025. This is our 5th year of doing the summit, and it sure has come a long way. And as an industry, as a group, I think, just looking around at this group, we all have come a long way, especially when you look at the last handful of years. They've been, as you'll see, some of the most challenging our industry has seen. And, we've all experienced challenges in our own ways, whether it's, in our business in the multifamily side, or it could be on the debt side, or it could be in a different asset class. But, we're all affected by how the market cycles and, turns and goes up and down, and we battle rates, and sometimes they go our way and sometimes they don't. But we have to be grateful for the fact that these challenges have made us much stronger. And if you are still in this room right now, you are one of the few and strong. So you should definitely be proud of that. We certainly are. So I want to talk about more specifically what those challenges are and talk about the state of multifamily. And of course, these challenges also create opportunity. So first of all, you've all heard it now for 3 years on end, but higher rates for longer. I don't need to beat a dead horse, but obviously we experienced the most rapid increase in interest rates in modern history. And that was precisely at a time when the Fed was admonishing and promising, saying, oh yeah, we're going to be lower for longer, and inflation is transitory, and we're not going to raise rates for 2 to 3 years. And then the exact opposite happened. So that's a major headwind, and it's a challenge that many still battle today. These problems are not problems that come on overnight and then regress overnight, right? These are long trends, and it's a long battle. And so got to stay in the game, got to persevere. Coupled with that, many of us have experienced difficult fundamentals, right? We were so used to everything going our way. You buy the deal and, oh, you must have the magic touch because rents magically went up while you're even under contract. You didn't even do anything. And rent growth, and everything was just going our way. And honestly, that's great, but you don't get better in that sort of environment, right? You get complacent. So now, for the last handful of years, we've been experiencing the opposite. Every inch of rent growth is hard fought, right? Every % of NOI or occupancy, those are battles won. So specifically when it comes to difficult fundamentals, every market is unique, but we've seen flat to negative rent growth. We've seen delinquency increase, battling all sorts of different things where it might be laggings in the eviction courts, and you've got to deal with your delinquency and get creative and things like that. And of course, why is this? It's because mostly supply. The demand story for multifamily is incredibly robust, right? You can pull up the charts, you can read the headlines, population growth, job growth, especially in the Sun Belt. These things you can't miss them. But as we all know, developers can overwhelm the demand story very easily. It's a lot easier to build in a rapid span of time than it is to actually make migration trends, population trends, job growth trends happen. So when the money was cheap and the rates were low, developers built, and that caused an influx of supply, and then that spurred on the more challenging fundamentals. Now, of course, when you have situations like this, all of a sudden people see a different landscape out there, and they see, oh, well, your 3.5 cap deal that you put under contract 3 months later is now a 4 cap because of rent growth. That's not happening anymore. Now, all of a sudden, debt and equity becomes tighter. Lending constraints increase, equity is more scrutinous, and the capital markets are overall tighter. And that's not good for people who are battling these problems, trying to still make their deals work. But with all these challenges, like I said, there's opportunities. And so that's really the name of the game of the cycle. And so unfortunately, as humans, we are perpetually at the mercy of our emotions. And what our emotions tell us is to get in when it's hot. And what does that mean? That means buy in when it's high. And then when it crashes, we get depressed and we sell when it's low, right? So when they tell you the name of the game is to buy low, sell high, it sounds simple, but it's very difficult to do. And so I'm not a market timer, and I don't think any of us, I think all of us in this room are too smart for that. And instead, we're market perseverers, right? We fight through the cycles and we go in when it's going up and we lean in when it's going down, and that's how you win in the long term. So now we find ourselves in exactly one of those opportunities where there are buying opportunities. There's a lot of people who are retreating. So instead of competing in best and finals, you might be competing in worst and finals, and you might actually pick up the deal at a discount. And then finally, just at the moment where people are pessimistic and people think that, oh, rent growth will never come back and will forever be oversupplied, and whatever asset class you're in, whether it's multifamily or something else, people say, I'm swearing that asset class off. It didn't work for me. I'm never going there again. Just at that exact moment, the fundamentals start improving. And before anyone can really notice it, all of a sudden, there's better trade-outs. Occupancies start increasing. Your collections start going up. There's rent growth. And now the tide is actually going in your favor. And so the difficult thing is to see it before it truly happens and to get in. And I'm not trying to say, hey, we need to get in now, right? Because we're not market timers. But once the trends are apparent and rates are low and rent growth is high, all the buyers are going to be back. And this room is going to be 3 times as big, right? It's going to be a crowded space again. So right now, the buying opportunities are because there is fear and because the fundamentals are just turning the corner, but not fully baked in. And then, of course, like with every cycle, the weaker sponsors are falling away, and that's why I want to just congratulate everyone who's in this room. You made a commitment to persevere. You're still here, whether you're an investor, a sponsor, operator, service provider, everything in between. It was easy to quit or to pivot. And so the value is in sticking to it. Now I want to talk about our edge at LSCRE. So one thing that I'm very proud of is that we have very few, actually only one bridge loan in the portfolio. So we are focused more than ever on long-term fixed rate debt, and we're getting more conscientious of our leverage, right? Because you can always add more leverage in the spreadsheet and the projected returns will only go up in the spreadsheet. That's the only way the spreadsheet works. But in real life, that's not exactly how it goes. And all of us have learned that one way or another. And so we'd rather be in the game swinging for singles and doubles rather than striking out going for the grand slam. Another major element that we are grateful for and lucky and truly lucky for are the property tax exemption strategies that we were working day and night for before they became popular, before they were cool, before everyone was doing it. And that allowed us to secure these long-term fixed rate loans and to increase our margins, reduce our operating expenses, and to have a competitive advantage in the market. Another competitive advantage is our in-house construction. So shout out to Jose and team. We have amazing people here who support us on the ground. We can do, I've seen it with my own eyes, we can pull off miracles. And I'll talk more about that, I think a case study coming up, but in-house construction is a game changer, not because we have turned construction into a profit center, which, it's not evil, but some people do that, but because it allows us to make the most of a situation, whether it's good or bad, right? Whether it's a value-add opportunity or whether it's more of like a distressed situation or deferred maintenance or a hurricane, which I'll talk about in a moment. And then finally, perseverance. I know I've been talking about that. Just fighting through, right? If the market was only going up, we would not get stronger, we would not get better, like I was saying. So I'm incredibly proud of our team and just how much better we've gotten. I look around at our team and everyone who's sitting in whatever position they're in, they do that job better than I could. And that's something truly, truly humbling and special. So speaking of in-house construction, I wanted to just highlight what that really means. Because you say in-house construction, and frankly, I've been saying in-house property management for years. I've been saying vertically integrated. But those words can be empty if you're not actually doing something with your vertical integration. And so this was a situation where we had hurricane damage at a property, and when you have insurance claims and you have major damage like this, it's never a fun, straightforward, pretty process. But long story short, we had basically bids for the construction work to repair and replace roofs and to remediate down units and things like that for between $700,000 and $1.1 million. And thanks to Jose and our construction team, we're able to complete the project in just under $350,000. So those are the real margins associated with doing construction in-house, because unfortunately, when you are a property owner of this scale, you own an asset that's 10, 20, $50 million, the world sees you as an opportunity. So knocking on your door every single day is some service provider. Hey, can we install electric vehicle chargers at your property? Can we do a termite inspection? Every day, someone is seeing you as an opportunity. And so, not to say that contractors are always taking advantage of you, but that maybe they are pushing for a larger scope than necessary. And so with in-house construction, we can get to the bottom of what supplies do we really need? What scope do we really need? Is this a replace or is this a repair? And so that's something that we are very proud of and want to continue to lean on and make it something that can really not just be a value add, but also be some form of insurance, right? When things go bad, can we clean it up? Another case study I want to talk about is Five Oaks. This is a property that actually I'm very proud of, because you look at the picture and it's a very pretty asset. It's built in 2008. It looks very nice, but it's actually not in a good location. It's, frankly, not in a location that I would be comfortable buying property or interested in buying property today. Not to say you can't make money in class, B- C areas. You certainly can, but your aura sleep score is going to be worse. So with that being said, I remember when I moved down to Houston last year, I had lunch with a couple of brokers, and I was telling them about this property. And this property was, as you can see, September 2024, occupancy was 73.5%. And it certainly didn't feel good when I took over operations and I took the occupancy from 80 to 74. And the reason why I did that is because I said, no, let's not keep the non-paying tenants. Let's clean house, no bad apples. Let's change the culture of the property. Occupancy is a vanity metric. I don't care if people are staying and not paying. I want people paying and staying. So it hurt, ripping the Band-Aid off, taking occupancy down, showing investors the true number. And as you can see, the true number is collections of $199,000 in September 2024. And at that lunch with those brokers, they laughed and joked about the submarket. They said that submarket has a lot of crime, that submarket has a lot of vacancy. You will never get that property to 90% occupancy. And I said, oh yeah, I will. I'll get it to 95. And honestly, I didn't fully believe myself. But our team most certainly did believe. And thanks to Joe Pistorius, the asset manager for the property, and Melissa, our director of operations, and so many more people, including my mom, Ina, overseeing the whole thing as COO, we were able to get the property as of August to finish the month at just under 96% occupancy with collections of nearing $260,000. So that is just a true testament to the team that they didn't give up. They saw a solution where there was a problem. For example, at this property, it's 240 units, 228 maybe, and I think 40 of the units are studios. And these studios were unleasable. They're empty. 0% occupancy for the studios. So why is that? Oh, well, because nobody wants the studios, I guess. That would have been the answer from the previous management. But we took a different approach. We thought, okay, well, these studios, they have potential. People just aren't seeing it. So we went out, bought a little bit of furniture, and we staged a model unit for the studio. And we showed prospects, hey, this is what the studio could look like. We did the imagining for them. And I can't believe it, but literally before you know it, the studios went from 0% occupied to 100% occupied. And now we've done away with that model unit. That model unit's no more. We don't need it. It's leased, and the studios are leased. That's pretty incredible. And then, I don't know how this case study didn't make it, but Rob Stanley here is a new partner in Preserve at Copperleaf, and that is a deal that is definitely a case study that we're super proud of. That's a property that it was the second property we bought last year. We purchased it at a time where, really there was no capital out there. The buyers were scattered away, and the seller was just looking for a willing counterparty. And so we were able to buy the property for very cheap at a right time, and couple that with an opportunistic property tax exemption, which allowed us to massively increase the NOI, I think by nearly 30% in 1 year. So we even went in at, call it 70% leverage, and we did a cash out refi in 13 months at the same leverage point roughly. With, we bought the property at 34 million, got an appraisal at somewhere in the 53 million range, and we were able to return back 45% of investor capital. So it's amazing that this early in the cycle, we're already starting to show the wins associated with getting in when the cycle resets. Because once you start seeing these wins, not just from us, right? We're not the only ones. There's plenty of other great people who are in the game and they're starting to see the wins. But over the next couple of years, once these wins are kind of circulating and everyone's aware of them, everyone's going to jump in trying to go and chase what was already done. And they're, I don't want to say they're going to be too late, but it's going to be a different environment. So that deal, Preserve at Copperleaf, is one where we're very proud of that one and feel like that marks what our new vision for the company looks like. Buying better quality assets in strong locations, newer vintage when we can get our hands on them, and really building an amazing team at the property. These are some other testimonials. Yaitza is one of our community managers. She was recently promoted to senior community manager for her hard work, and she loves how she feels heard at the property. I was in Houston this past week, and I stopped by at her property unannounced, and she, just started talking. And that's the key. You just need to have people who are on the ground. They actually walk the property. They are willing to tell you the secrets and go out on a limb. And when you appreciate them for that, obviously they're going to do that more. And she said, my proudest moment at LSC has to be improving the property score from 78 to 95. It was a big challenge, but I pushed through and got it done. That was a huge win for me, and I'm proud to keep raising the bar. And then finally, we snuck in a little resident testimonial as well. I feel like, we're always talking about investors, we're talking about lenders and all this sort of stuff, but, really none of this can happen without the residents. And like any business, we all know how tough it is if you have to churn and burn in your business. You get a sale and you got to go get another one and another one, right? The best businesses are the ones that really thrive off of word of mouth and repeat and referral. And so Katie at Meritage, she said, I just renewed my lease for the 4th year at Meritage. We bought the property in 2023, so we've owned the property now for a couple years. She says the staff is fantastic and maintenance requests are always handled quickly. These are the sort of things that gets people to renew, right? Maintenance issues, your maintenance staff is basically like, resident relations staff, right? Like investor relations. So a renewal is the biggest compliment that we can get in this business. So finally, what's next? Like I said, there will always be challenges, but right now is the best time to persevere and invest. So for us, we're staying focused on multifamily. The grass is not always greener. We're going to just stick to what we know. We're going to continue to build on our experiences, some good, some bad, learn from our mistakes, stay focused on Texas, where we have our operations, continue to institutionalize our operations. We have, led by Hannah Wyatt, we have built an amazing HR department and continue to grow. Something that previously, we've hired over 100 people in the last year or so, and that would have never been possible without hiring people to do the hiring, right? And to have the expertise and just honestly the love and care for the mission. Another big thing that I'm proud of is accounting and tax. These are things that are not sexy. Craig is always complaining to me, nobody wants to hear about operations. They want to hear about the big deals and the lender and the all that sort of stuff. But if you want to talk operations, you can come to me. You can come to Ina, Jose, Melissa, Corey, our asset managers. Our company it's like 90% operations and 10% of the sexy stuff now. So that's there's a lot of people here to talk to about that kind of stuff. But as far as accounting and tax, we have hired 2 CPAs. So we're incredibly excited to be bringing in tax in-house, being never late on K1s, really being proud about every detail of the process. I could go on and on. We're just learning and getting better. I don't want to make this all about us, so I apologize. But we want to partner with people who see the long-term vision as well. Buying smarter, using lower leverage, really treating location as the number one thing, not what the spreadsheet says as far as, oh, can I double my money in 3 years? Right? This is what's going to keep us all safe and keep us in the game for the long term, because that's really the key. The key is staying in the game for the long term, not necessarily making it big on one particular deal. Okay, that I think wraps it up for me. Thank you so much. Yeah, so don't go anywhere unless it's an emergency, but we're gonna do the financing fireside chat right now. So we've got Brad, we've got Nate. Let's get straight into that.